Well, millions of Americans' retirement money is in something like an IRA or a 401k. And why not? Again, basically, companies walked away from the old pension starting in the middle to late 80s because the 401k came around. And then the Roth 401k came around. And so, again, companies are like, heck, our responsibility is the match, and then we're done. And that's why so many people have saved in 401ks and IRAs. The whole U.S. retirement assets are more than $45 trillion. And with retirement assets accounting for at least 34% of all household financial assets in the United States, that's a lot hanging out there. This is Retire Colorado, along with Alicia and Josh Lewis. I'm Bruce Steinbrock. Alicia, it is. I mean, let's face it. We have put a lot of money, packed it into, I remember my parents telling me when I graduated college in 1989, they were like, make sure you're saving in that 401k, get in that match. That is free money. And it is great advice. But the majority of that money I earned in my first 25 years of work life was money that was pre-tax. And so at some point in time, Uncle Sam, he's just sitting there going, hey, I need my cut. And that's a lot of money to be hanging out there.
Yeah. And, this was, I would probably say a really great governmental scam, if you just want to get really into it. But if you think about what everybody was told for so many years is that, delay that tax because when you get into retirement, you're going to be in a much lower tax bracket. And because you're not going to spend as much. That's what people would think. And I'm like, no, when you're in retirement, you're spending more because you're doing all the things that you want to do. You're living your retirement dream.
And you have time because you're not at work. I think that's what most people underestimate.
Yeah. So, we do have a lot of these conversations of, okay, that's great that you've saved and a great place to save, but we have a little bit of a problem. We have a little bit of a tax issue here. And so that's where, again, planning really comes in handy, making sure that you have that retirement plan. Because what we want to look at is, of course, what are your taxes today in retirement based on, the different income streams that are coming in, but also 5, 10, 20 years down the road, what are some of your tax liabilities? What is your RMD going to be? And how is that going to continue to grow? Because again, the IRS has a lien on that money. The IRS is kind of like your partner,
silent
like your business,
partner.
Yeah, your business partner. Unfortunately, the IRS and your business partner gets to choose at any given year what percentage of partnership they are, and you don't have a say in that. And so we like to remove that say and get ahead of that and do some planning. And sometimes that's some Roth conversions can be a very, very powerful play there. But again, this is where planning is everything. And if you're not getting ahead of it now, what it's going to do is it's going to bite you in the butt later. And taxes they're on sale and they're the lowest that you will ever see in your lifetime ever again, is what we believe.
Yeah, no doubt. And again, if you've earned a great wage and you have a lot saved and the RMD age happens, you may not be in the tax bracket you think you're going to be in. And that's why, again, don't just go out and willy-nilly say, well, I heard Joe at the water cooler talking about that Roth 401 or, the conversion to Roth. You've got to do that in a smart way because it's a taxable event when you do that. And Josh, as we get into some of those options, certainly understanding what type of 401k or IRA that you have matters. And then, just taxing of retirement income. It's just key to understand all this.
Yeah, that's a big one. And I think a lot of people don't necessarily understand that dynamic when they start contributing to those accounts. So when you look at like your 401ks, 401as, 403bs, 457s, all those are pre-tax accounts, right? So when you're making those contributions, you're going to reduce your AGI, your adjusted gross income, by the amount you contribute inside of those accounts. So you're getting kind of the tax benefit in the year you make the contribution, and then it's taxed like ordinary income sometime in the future when you're taking money out of those accounts. So that's why we're big advocates of like your post tax retirement accounts, which would be your Roth IRAs. So, and really you could have all of those same accounts, but just with a Roth. So like a Roth 401k or a Roth 403b. And you're not going to get the tax deduction when you make that contribution. That's after tax money. So you're not getting the tax break early on, you're getting it down the road. And the beauty of that is when you make those withdrawals, there's a couple requirements that go with it, but that's going to be principal and interest tax free when you make those withdrawals out of your account. So huge difference there just in terms of tax planning for retirement, but it's really important to know and understand the difference and make sure you're saving in the proper accounts, because kind of like what Alicia said, if we're living in a historically low tax environment today, does it make sense to defer those taxes now when we know that there's a really high likelihood that tax rates are going to go up? And our answer is probably not, right? So let's look to maximize those post-tax accounts while we can, while the tax rates make sense to do so.
Well, let's face it, our debt, our national debt is approaching 40 trillion. I don't think people appreciate how many zeros and all that is. I mean, that's a lot of money, 40 trillion. It's not there yet, but it will be. And so having a plan for that is key. And Alicia, with your 401k or your IRA, it's important to know rules for taking money out of those accounts. Now, I'm approaching 59 and a half. So that's kind of a key time. But what do we need to know when it comes to taking required minimum distributions, which is, of course, 73 and will be 75, but also just some things that you can do when you turn 59 and a half and some of those rules that are out there?
Well, and again, this kind of comes back to making sure that you have a plan. And I know that I say that all the time, but it is not just like, oh, I've got this retirement plan. It really is, here is the order of how I'm taking money out, and here's how it's going to be taxable, and here's how I'm setting myself up for a better future from the tax perspective as well. And so when we talk about, Roth and 401ks and IRAs and all the things, of course you can't take money out until you're 59 and a half. And this is where, again, I was talking to somebody the other day and they were like, why, I really, really love that I can, give the max into my 401k and it's just taking it right off the top and I'm not paying tax on that. Like, I just don't really want to shift over to Roth because then I'm going to have to pay all the more taxes. And so we talked about that, paying tax on the seed and not on the harvest, and kind of just what we all talked about here. But there are some things too when people are doing Roth conversions. And, again, coming back to, it is painful to write that check out when you're doing Roth conversions. Like, you're paying taxes on that money to then have it go into a Roth, but forever that money is growing tax free. So super, super powerful. But we can't take money out of that account for 5 years, right? Because it has to be able to sit there and grow. And so making sure that we have the timeline properly laid out of, here's the Roth conversions, here's when we would expect to take money off of that. That is, again, part of the big picture planning and part of the just micro planning as well. So really important to know the rules, really important to know how and when you're going to be taking those distributions out. And so, when people haven't saved in Roth, here's the other thing. A lot of times, a lot of the people that we are working with make more than what they're allowed to contribute to Roth. And so they're like, well, Roth has never been an option for me. And that's where we start looking at the Roth 401ks, because it doesn't matter how much money you make. And you can still contribute to a Roth. So we might shift some of the contributions, some or all, if we can, into those Roth contributions. But it is really important to know the why with the what and not just be kind of willy-nilly about it. We want to have a purpose and be intentional.
Yeah, these are going to be educated decisions, folks, and ones that Alicia, Josh, and the team discuss with you. Again, it's like coming around the kitchen table and have an important conversation about you and your retirement. If you're married, you and your spouse and your retirement. Reach out today, 970-446-1234, 970-446-1234. You can text the word VISIT to set up that initial consultation. VISIT, just text it to 970-446-1234. This is Retire Colorado with Alicia and Josh Lewis. I'm Bruce Steinbrock. Josh, a couple of issues to address when we talk about taking money out. Now, the taxes that can apply when we're withdrawing the income there, but, penalties if you do it wrong. Let's unpack this a little bit. What do retirees need to know just about withdrawals?
Yeah, so I think primarily it's just to have a strategy behind those withdrawals. So a lot of times people might look at a certain account and say, well, I want to take my money out of there. And I say, well, why? And they go, well, it's my after-tax account. I'm only going to have to pay a capital gain structure on that. Whoops. So it's a lower tax liability on an ongoing basis. So we want to look at that in a meaningful way and say, hey, maybe we want to shift to taking money off our IRAs because, again, taxes are lower. That money's subjected to required minimum distribution. So depending on how that sort of segments into your overall plan, we want to make sure that it's giving good continuity for the future. So we don't want to necessarily take money out of all of our after-tax accounts and then get stuck with a high RMD sometime in the future, because then that's when we get into those IRA dollars and the government is telling us now you have to take that money out over a period of time. So we really want to look at how are we spending that in a meaningful way? How are we maybe using like a blended withdrawal strategy so we have some different tax accounts where we're taking money out so that we're managing our overall tax liability in terms of our total income plan. So there's a lot of different nuances that go with that. It really depends on kind of how your accounts are structured. If your spouse has accounts, age differences, Social Security, all of those things to make sure that we're working together to make sure that it's working in the most tax efficient way, not only today, but 10, 20, 30 years down the road.
Yeah. Folks, there's a lot to unpack. And again, you should never make just a snap decision because, well, somebody told you that, or that's what you thought, or you read something on the internet. You want to put fact and mission behind it. And that's what Josh and Alicia and the team at Lehman Lewis do. They give you facts. They let you put mission behind what you're doing. And again, at the end of the day, they act as your CFO, your chief financial officers. You're still in charge. You're the CEO. But why not put multiple brains behind your decisions? That's what Alicia, Josh, and the team at Lehman Lewis offer you. More brain power behind the decisions for your retirement. Reach out today, 970-446-1234. And we've got more Retire Colorado straight ahead.